Financial Literacy Summit program hosted by WeCARES and also Will Way CEC. And we are covering the budgeting and money management, talking about spending, budgeting, and savings. And I just want to give thanks to Mr. McCowan for allowing us the opportunity to be able to come and to be able to educate the community. And that is how we do it. This is what we do. All right, just a little brief introduction about myself. Be your facilitator. I am Renix Graham. I am the Financial Literacy Facilitator, co-founder of Will Way Community Enrichment Corporation. And of course, I am a business entrepreneur. I am the senior field manager in the financial service industry. I've been serving in the financial service industry for 9 years, and it's been fun, wonderful thing, a passion that I love to do. And I am multi-state licensed in several various states. Also, I cover the healthcare insurance industry, life insurance industry, along with retirement accounts. That covers IRA, 403B, and also 457B accounts. All right, and so for today's agenda, we will be talking about what is a budget. Simple question, but many may not know how a budget works or what does a budget even means. And so we'll find out what truly is a budget. The next one, we'll be talking about how to budget in 7 simple steps. And also we'll cover money management, and also we'll talk about just some of the simple key takeaways from this segment as well. So the question is, what is a budget? What truly is a budget? And a budget is essentially a forecast of both your income and expenses for a specific future period. And it's a tool commonly used by governments, is used by businesses, and it's also used by individuals alike to manage their finances effectively. And so for individuals and also households, budgeting serves several purposes. It helps in managing monthly expenses. It helps preparing for unexpected events. Things happen, things end up coming up, and it's out of our control. Those are unexpected events. And also saving for significant purchases without accumulating any debt at all. And so, contrary to common misconceptions, budgeting doesn't have to be tedious. It doesn't have to be that way. It does require advanced math skills or restrict your spending habits, but instead it provides a clear picture of your financial inflows and outflows, granting you better control of your money. And so it's all simply predicated on just how you use your money, your plans for your money. What will you spend? What will you invest? All right. Or what will you save? We will call it a pie chart. There's certain segments in terms to how you will operate and allocate your funds based on the budget and even the use as well. And so a budget can manifest in one of 3 ways. It's a surplus balance, or even in a deficit. So you got a surplus, you have a balance, or a deficit as well. And so with those 3, a budget represents a financial plan and is highlighting the balance between income and expenses. And it outlines the choices made when allocating resources between different goods or services. Regarding its impact, and a budget can manifest in 3 ways. Once again, that's the surplus, the balance, or a deficit. And so a surplus budget signals expected profits, indicating that income surpasses expenses. A balanced budget implies that revenues, expenses are projected to match each other, reflecting financial equilibrium. Conversely, a deficit budget indicates that expenses will outstrip revenues, hinting a potential financial balance. And so specifically, starting with the first one, the budget surplus, that's the condition where it arises when income exceeds expenditures, right? It's a term frequently associated with financial health of corporations and governments, contrasting with the concept of savings, and typically is used for individuals. And so a surplus suggests effective financial management, particularly in government finance. And so the counterpart to a budget surplus is a budget deficit, where expenditures surpass income, reflecting a common challenge in managing public finances. So that's covering the budget surplus on how that works. The second one is balanced budget. And this scenario occurs within financial planning or budgeting when total expected revenues equal total planned expenditures. And so, although this concept is often linked with like government budgeting, primarily when it comes to balanced budget, the government typically are the ones that are handling that. It applies across a whole bunch of entities. A budget is deemed to balance retrospectively after a year's revenues and expenses are tallied and also assessed as well. All right. The third one is the deficit, the budget deficit. A deficit arises when a government spending surpasses its revenue, serving as a critical measure of a country's financial health. And so this term is used in the context of government finances rather than business or individuals. So budget deficit contributes to the national debt, which is the aggregated of all annual deficits and the total amount of country owes to its creditors. And so we're understanding that the budgetary outcome is crucial for assessing the financial strategies and health of government businesses and individuals alike. And so that's how that works as well. And so just a breakdown on just the budget manifestation. You have, once again, the budget surplus, just kind of just touching over those three once again. It's a budget surplus. This is the condition arises when income exceeds the expenditures, right? If we have like a surplus of income that's more than what we will have to spend based on the debt to income ratio. You have an income that exceeds that. We have an overabundance, an overflow of income. And so that's the budget surplus. The budget balanced or the balanced budget is this scenario occurs when within the financial planning or budgeting when total expected revenues equal total planned expenditures. So this is where the income and expenditures is all equal out with each other. And then you have the budget deficit. The budget deficit is where the deficit arises when a government spending surpasses its revenue, serving as a critical measure of a country's financial health. So now it's the opposite way around. It's like a balance beam. You got budget surplus, we got way more income coming in. Budget balance, we have an equal amount of income taking care of our debt, or we're taking care of our expenditures. Then we have budget deficit, where the deficit, we have so much overhead, we have so much we have to owe to different countries, and we're just, in this insurmountable amount of debt. It's way more than what we can get based on income. So our income is being swallowed up by the expenditures. And that's just a breakdown of the budget manifestation in terms of how that works as well. All right. Now we want to talk about how to budget in 7 simple steps. All right. With that is the specifics of your budget will depend on your personal financial situation and even your goals. However, in most cases, the steps for creating a budget remains consistent, and it can craft a budget you following the 7 simple steps. All right, we'll dive in terms of how the actual 7 simple steps work as well. And with the 7 simple steps here, this is what we're looking at. 1, calculating your total income. 2, monitoring your spending. 3, define your financial objectives. 4, determine essential expenses. 5, assessing debt obligations. 6, create a spending plan. And 7 is to adjust and optimize your budget as well. And now we're going to go with number 1 when it comes to calculating your total income. When it comes to that, this is dealing with your net income, right? Or we will say the acronym NI. NI stands for net income. Alternatively, is known as net earnings, and it represents the difference between a company's total revenue and all associated expenses, including cost of goods that is being sold, selling, general and administrative expenses, operating expenses, depreciation, interest, taxes, and other incurred costs. And so it serves as a crucial metric for investors, indicating the surplus generated by an organization's operation. Displayed prominently on a company's income statement, net income is a key indicator of its profitability. So in personal finance, net income similarly denotes an individual's earnings after factoring in taxes and deductions. And so going back to net income, NI, that's the acronym for net income, it often refers to as what we consider the bottom line. And it occupies the final position on the income statement, being that the results are subtracted all expenses, interest, and taxes from revenue. Okay, so that's number one with the calculating your income and how that works. Number two is monitoring your spending. Now, when monitoring your spending, this is where a checking account, like at a bank, for example, serves as a convenient tool for managing expenses and bill payments, especially when using a debit card, right? We always use a debit card frequently, right? That's associated with our banks. And with the advent of online and mobile banking, monitoring debt and credit transactions has become increasingly effortless. So, however, how frequently you should keep tabs on your checkings accounts? That's a question. How frequently, are you keeping tabs of your spending, of your savings, even your spending, going back and forth? How often are you looking at the health and the balance of your account value in your bank as well? And so, according to a survey conducted by Lexington Law, 36% of Americans review their checking accounts on a daily basis, while 30% opt to check it once a week. That's a pretty low number. It's less than half. And we need to bump those numbers up. We need to get to 80 to 90 to 100% of these Americans to be more cognizant and to be more aware of the balance of their checkings and also savings account as well. All right. Now, regularly monitoring your bank activity is important. It is truly essential, particularly if you aim to safeguard against fraud or minimize fees, right? So whether you're spending or whether if you're opening up your bank account or checking account or looking to enhance your current banking habits, these tips can provide valuable guidance. And so that is number two with monitoring your spending. Number three, define your financial objectives. Now, financial goals represent the overarching objectives you establish for your savings and spending habits. And so these goals can encompass short-term aspirations or long-term plans. Regardless of the time frame, proactively identifying your goals, your financial goals, can significantly enhance your ability to achieve them. All right. Now that's where you're covering the area of defining your financial objectives. What are your purpose for that? All right. Number four is determining the essential expenses. All right. We have the 70, 20, and 10 budgeting rule segment for post-tax income in three distinct proportions when it comes to budgeting. You have 70% allocated for daily living costs, take care of your bills, taking care your cost of living, right? Just to be able to live, bills, to enjoy life, things of that nature, right? You have 20% is dedicated to savings and debt repayment. So out of that 20%, maybe 10% going to savings, 10% is going to the debt repayment. Either way, that 20% is specifically with focus is going straight towards the either savings or the debt repayment or even both. And you have the 10% is reserved for extra savings or for charitable contributions as well. And so this method of dividing your income into those specific categories, it will help you more effectively to oversee your daily finances as well. So now with that 70, that 20, that 10 rule, that will tell you, okay, I'm spending a little bit too much, or this is my limit on what I can spend on myself, to buy the clothes that I want, to go to the movies or go to the restaurants. Most of us like to eat, like myself. I love to eat, right? But I have to have a limit. If I can't go out to eat, then hey, you know what? I need to find what I have in my cupboards or in my refrigerator. I might have some food some meats in the in the freezer. Got to utilize that. But at the end of the day, you know your limit and what you can and cannot do. And that's what the 70-20-10 rule of budgeting will help you with that as well. Number 5, assessing debt obligations. When it's time for our financial self-assessment, we have to assess our debt obligations. And so with debt service, it encompasses the payments made to cover both the interest and the principal of a debt within a specified time frame. And the concept is applicable to various types of debt, including personal debt like home mortgages and student loans, as well as corporate or governmental obligations such as business financing and bond issuance. All right, the capacity to manage debt payments is a critical consideration for individuals seeking loans and for businesses aiming to secure additional funds for operations. And so servicing debt implies fulfilling the required payments on it as well. And some of the key points within that frame there is talking about debt service involves the payments necessary to settle both principal and interest on the debt over a certain period of time. And then you have the debt service coverage ratio. All right, that's the acronym for the DSCR, debt service coverage ratio. And that is a metric used to assess a company's financial leverage and ability to manage its debt. All right, then the next one, you have potential lenders or investors assess a company's debt servicing capability to ensure it can handle new debt in addition to its existing financial obligations. All right, next you have a company. And we're just using companies as an example in terms of how they assess and all. They also, with when it comes to budgeting, is that a company must demonstrate steady and dependable earnings to sustain a substantial debt burden and meet its debt obligations. All right, 2 more left. We got create a spending plan and adjust and optimize. Now, create a spending plan. This is where a financial plan is a comprehensive document outlining an individual's present financial status alongside their short-term and long-term financial aspirations, and is detailing the approaches of accomplishing these objectives. And so this plan serves as a roadmap for assessing essential needs such as risk management pertaining to health or disability, budgeting for income and expenditures, and strategies for reducing the debt as well. It offers financial direction, ensuring readiness to fulfill both the current and future financial commitments, and also the goals as well. Additionally, it facilitates monitoring for your advancement over the time towards achieving financial health. And so financial planning, it requires an in-depth review of your financial situations, examining the income, the expenditures, the debts, and savings, and setting realistic future expectations. And this plan can be much more formulated on one's own or with the assistance of a certified planner as well. You have some certified planners that are available that even help you to just kind of give you some advice, to give you some recommendations on how to fix that or how to work with assessing your financial plans. And also some of the key insights within the creating that spending plan is that a financial plan outlines an individual's financial goals for short-term and long-term with a plan to achieve them. And so that's the goal there. And so the plan must be detailed and tailored to the individual, considering their personal and family financial necessities, investment risk tolerance, and strategies for saving and also investing as well. Financial planning begins with assessing one's current financial standings, including net worth and even cash flow as well. All right. And also a robust financial plan, it acts as a guide over the course of time, and it's allowing individuals to measure their progress towards their financial objectives. All right. And the last one we have is number 7, adjust and optimize. And so we regularly review your budget, right? And it's the budget and the spending plan to make necessary adjustments. And so life changes and financial goals evolves. So your budget also, it should also evolve as well. It should also do the same thing. And so this step here with number 7, this step ensures your financial plan and it stays aligned with your current needs and also your future ambitions. And so investment fees are an inevitable aspect of investing, but that doesn't mean that you have to overpay them. All right, many investors overlook their investment expenses during the prosperous times, unaware of the significant impact these seemingly minor fees can have on their returns as well. And so consider a $100,000 investment portfolio, pretty large investment portfolio, right? So if you're charged with a 50% fee, or we would say a 0.50% fee in fees annually for over the course of 20 years, those fees will chip away $10,000 from your portfolio's value. And if the fees escalate to 1%, that's going to be huge, right? That erosion increases to nearly 30%. I'm sorry, not 30%, $30,000 over the same period. And for investors seeking to optimize their portfolios and minimize investment fees, several straightforward strategies can be employed. However, before delving into methods or to reduce these fees, it's crucial to grasp their nature. And so although regulations and mandates clear disclosure of investment fees and the complexities still bewilders many of the investors who lack the time to navigate lengthy sessions with this, like when it comes to assessing their stuff, shockingly, it's to them, it's like, oh man, it's a lot. It's just a lot, right? And so just going over just a little bit here regarding the statistics. In 2001, AARP, okay, they surveyed 401k plan participants, revealed that a staggering 71% were unaware that they were paying all those fees. And so they're like, okay, what's going on? Why are we're not really seeing our savings really hit the mark like we want to hit the mark? We're paying way more fees than what we're saving. And for the fact that AARP discovered that 71%, that's a lot. 71% of the people are unaware of those fees. They didn't even know they were paying those fees at all. And so it's a lot. And so one of the most familiar fees is the expense ratio. And so which encompasses administrative fees, you have management fees, advertising clause. These are all things that are associated within the 401k that comes with a lot of fees just to even manage your account, especially when it's participating in the market, right? In this case, the expense ratio varies depending on the investment. Additionally, investors may face commissions if the fund utilizes a brokerage firm to promote its products. And so while fees cannot be entirely circumvented, they can certainly be minimized from opting low-cost funds to adopting a more passive investment approach. And so here are 4 strategies to reduce for your overall investment when it comes to that. All right. Now with the 4, I thought it was the 4 strategies were here, but it's not here. So we'll just go right on to the money management. My mistake, you all. All right. So we're going to cover the money management part here. We're talking about the budgeting. Now we're talking about money management, kind of similar to the same, but we'll just get through this here as well. Now with money management, it encompasses the practices of budgeting, savings, investing, spending, generally supervising the use of funds by individuals or even the groups. And so it can also specifically denote investment management and portfolio oversight. In financial context, it predominantly signifies professionals making investment choices for substantial capital pools like mutual funds and even pension plans as well. Okay. With that here, under the category of money management, okay, we're looking at it where you're overseeing the capital And overseeing the capital, it encompasses various assets that confers value or benefit to their owners, ranging from physical assets like factories and machinery to intangible assets such as patents and financial holdings. And so while money itself can be considered capital, the term is more commonly associated with cash deployed for productive or investment purposes. It plays a vital role in sustaining daily business operations and also fueling future expansion. Businesses acquire capital through their operations or by securing financing through debt or equity. Various sources contribute to capital formations, including personal savings, support from friends and family, investments from angel investors or venture capitalists, corporate resources, is a list of them, governmental funding, private loans, revenue generated from operations, and publicly an IPO. That's the initial public offering, right? In budgeting, businesses typically manage three primary types of capital. Here is working capital, equity capital, and debt capital. However, financial enterprises often recognize trading capital as a fourth essential component as well. All right. And with that, those how that works as well. Now we want to figure out here regarding the, let's see, some of the key takeaways here. We get right here into the takeaways. Go back to this here. Pardon me, y'all. Get my slides back. Okay, here we go. Sorry about that. I'm running way ahead. Investment management. Investment management. What is an investment management? Investment management involves the comprehensive management of financial assets and also various investments extending beyond mere transactions of buying and selling. And so with this here, this encompasses the formulation of both short and long-term strategies for acquiring the liquidating portfolio holdings. And it's additionally investment management, and it may encompass ancillary services such as banking, budgeting, and also tax-related responsibilities. Primarily, investment management pertains to the oversight of assets within the investment portfolio, including the strategic trading aimed at realizing specific investment objectives. Synonyms for investment management includes money management, portfolio management, and also wealth management as well. And now we want to understand the financial markets. When it comes to the financial markets are essential in facilitating resource allocations for businesses and also entrepreneurs. And they provide a platform for seamless transactions between buyers and sellers as well. Like that's the way the stock market performs. There's a lot of buying, there's a lot of selling, and also there's a lot of trading that are taking place as well. And so while the stock market represents a prominent example, financial markets encompass a broad spectrum of instruments, including equities, bonds, currencies, and derivatives, among others as well. And with these markets that hinge on informational transparency to ensure the efficiency and accuracy of pricing mechanisms. And so with financial markets vary in size and activity level, with some exhibiting minimal activity while others, such as the NYSE that stands for the New York Stock Exchange, and it witnessed daily trading volumes reaching trillions and trillions of dollars. And specifically, the equities market enables investors to trade shares of publicly listed companies with initial offerings occurring in the primary market and subsequent trading transpiring in the secondary market, where investors engage in buying and also selling the existing securities as well. So there's a lot of initial public offering, IPOs, companies that are IPOs that are publicly being offered by way of selling. There's a lot of sales and a lot of buying that goes on within those trades. And what they're doing, they're purchasing value and also purchasing the equity as well. Last one is the pension plan. A pension plan typically necessitates contributions from both the employer and optionally the employee, which are often deducted from the employee's wages. And so employers may further incentivize savings by matching a portion of the employee's annual contributions up to a predetermined percentage or even a dollar amount. And so broadly, there are two primary types of pension plans. You have defined benefit, and also you have a defined contribution plan as well. And so those are just the money management ways how you can manage your funds. It's overseeing the capital, financial markets, investment management, and also through your pension plans. And that covers pretty much the four bases of how that works as well. Okay, now we just want to talk about real briefly the just some key takeaways from the money management here. All right, the money management encompasses the procedures employed to record and oversee finances, whether for individual households or organizations. Okay, it also pertains to specifically to investment and portfolio management. So that's how that works with that. Also, financial advisors and personal finance platforms, including mobile apps, are becoming more prevalent in assisting individuals in enhancing money management as well. And financial advisors, personal finance platforms, I'm one of them. I'm the one that also helps just to kind of give clients a better overall broad scope in terms of how it works regarding their finances. Also, another key takeaway is inadequate money management can result in debt cycles and financial stress. Remember, we were talking about the expenditures versus our income. You got expenditures, which is overhead. If you have that and it's not being properly managed based on your income and money management and budget, it will be swallowed up by your debt. It'll be swallowed up by your overhead. We don't want that. We want to avoid that at all costs. And then among the largest company managers based on assets under management, AUM, that's what it stands for, are BlackRock, Vanguard, and also Fidelity. And those are the three of the big, largest money managers in the world: BlackRock, Vanguard, and also Fidelity as well. And so those are just some of the takeaway points here, but this is all I got. I'm so grateful that y'all were here to spend time with me, and grateful to be here to spend time with you all. And once again, thank you to Mr. McCowan and WeCARE's program. And if y'all have any questions, reach out to us, stop by our website, come by and see us. We'll be glad to work with you, answer any questions that you may have. That's our website, willandwaycec.org. We have our general email, that's contact@willandwaycec.org. You can also follow us on the social media platforms. You have the Instagram, Facebook, and also YouTube, and that's at Will and Way CEC. All right. And so, yeah, this is our financial literacy program. So we've covered here, we have the 4-6-8 rule. We talked about that. That was the last segment. And then we have the budgeting and money management. Then the next one we look forward to is financial planning. And I really look forward to that one as well. And also, if you look to learn more about WeSERVE's WeCARE program, visit at WeServeVA, and that's www.weserveva.org. And they have wonderful, good programs and information for you there. But yeah, this is how we rock and roll. This is what we do. This is how we do it. We also want to hear from you. We would love for you to take a survey, give us our feedback, and just let us know how we can better serve you as well. Quality is definitely our mantra. Quality is our focus, and that is definitely what our principles stand on, is the quality that we like to offer and to help educate our community as well. So feel free to take a survey. It's only 2 minutes of your time, and we will greatly appreciate it. But other than that, you all, that's all I have. Thank you once again, Mr. McCowan, for this wonderful time, and I look forward to seeing you all in the next one. All right, y'all, have a great one.